Over a weekend in Longmont, Colorado, a small team of MiniScribe finance staff worked in a locked room from a set of written instructions. Their task was to raise the company's reported inventory. According to the account, later established in litigation and reconstructed by the company's own investigators, part of that task involved gaining access to the packages in which the outside auditors had sealed their inventory count records and altering the figures inside. In a separate part of the operation, elsewhere in the company's distribution chain, employees packaged construction bricks inside disk drive shipping cartons, brought them to the weight of a genuine drive assembly, and recorded them as finished product shipped to distributors. The question this episode answers is not why people would do this. It's how a hard drive manufacturer could book bricks as revenue and hold that fiction together across multiple reporting quarters, past an outside audit, inside a public company, until the ledger itself could no longer absorb the load. Begin with the instrument at the center of this case, because the bricks are the memorable image, but they are not the mechanism. The mechanism is revenue recognition, and specifically two devices within it: bill and hold sales and the treatment of inventory as an asset carried at cost. Consider how revenue recognition is supposed to work. A manufacturer produces a good. It ships that good to a buyer. Title passes, the buyer takes on the risk of ownership, and at that point, the seller records revenue and recognizes the associated cost of goods sold. The inventory that leaves the warehouse moves off the balance sheet as an asset and onto the income statement as a cost, matched against the revenue it generated. This is the matching principle, and it is the spine of accrual accounting. Revenue is earned when the earnings process is substantially complete and collection is reasonably assured. For a company that makes physical objects, the shipment of those objects to a customer who ordered them is ordinarily the moment that test is met. Bill and hold is a recognized exception to the shipment rule. Under a bill and hold arrangement, a seller invoices a customer for goods but retains physical possession of them, holding them for later delivery. The buyer has committed to purchase. Title has passed, but the product sits in the seller's warehouse rather than the buyer's. The SEC has long recognized that revenue may be recognized on a bill and hold basis, but only under stringent conditions. The buyer, not the seller, must have requested the arrangement and must have a substantial business purpose for it. The risk of ownership must have passed to the buyer. There must be a fixed delivery schedule. The seller must not retain any significant performance obligations, and the goods must be complete, segregated, and ready for shipment. These conditions exist precisely because bill and hold severs revenue recognition from the observable event of shipment. Without shipment as the anchor, the recognition depends entirely on the terms of the arrangement, which are documents, and documents can be written to say whatever the drafter wishes them to say. That is the structural vulnerability. Ordinary sales are disciplined by physical reality. A product either left the building or it did not. Bill and hold removes that discipline and replaces it with paperwork. The revenue becomes real when the company says it is real, subject only to the conditions being met, and the conditions themselves are verified by examining the company's own records of the arrangement. Now, the second device. Inventory on a manufacturer's balance sheet is carried as an asset, valued at the lower of cost or market. When a company reports its inventory, it is asserting that it holds physical goods, raw materials, work in process, and finished product of a stated value. That value flows through the financial statements in a specific way. The cost of goods sold in any period is calculated as beginning inventory plus purchases minus ending inventory. Read that relationship carefully, because it is the fulcrum of the entire fraud. If a company overstates its ending inventory, it necessarily understates its cost of goods sold for the same period. And if cost of goods sold is understated, gross profit is overstated by exactly the same amount. Inflating the inventory figure on the balance sheet automatically inflates profit on the income statement. The two statements are joined by that single arithmetic bridge. This is why inventory is one of the most audited line items in any manufacturing company, and why the physical inventory count is a core audit procedure. The auditor does not simply accept management's stated inventory value. The auditor observes the physical count, tests quantities, and traces them into the valuation. The count is the point at which the accounting abstraction is checked against the physical world. If the count is honest, the arithmetic bridge holds. If the count can be corrupted, both statements move together, and the fraud writes itself across the entire financial picture in a single stroke. MiniScribe used both devices. It recognized revenue on shipments that were not genuine sales, using bill and hold treatment and channel stuffing to book product into distributors that had not truly bought it. And it inflated the inventory that remained, so that cost of goods sold was suppressed and margins looked healthy. The bricks are where these two devices meet. A brick packed in a disk drive carton is simultaneously a fictitious shipment, generating fictitious revenue and a way to make the physical count reconcile to a fictitious inventory record. One object served both frauds. That is the structural elegance of it, and it is why the case is studied. To understand the architecture, begin with the company's position. MiniScribe manufactured hard disk drives. The disk drive industry in the 1980s was intensely competitive, with rapid product cycles and severe price pressure. Component costs fell continuously, product generations turned over in months, and a manufacturer that missed a design window or a volume target could see its margins collapse. This is context, not excuse. It establishes why the reported numbers mattered so much, and why the gap between actual performance and expected performance created continuous pressure on the reporting function. A company in that environment lives and dies by whether it hits its numbers, because its access to capital and its standing with customers depended on the appearance of consistent growth. The financial architecture the company constructed to bridge that gap had several distinct components. Consider them as steps. Step 1. Channel stuffing through forced shipments to distributors. The record establishes that MiniScribe shipped product to its distributors in volumes that exceeded what those distributors had ordered or could sell. These shipments were booked as sales, recognizing revenue and moving inventory off the books at a profit. But the goods had not truly been sold in an economic sense. The distributors had not committed to keep them. Where distributors held a right of return, or where the arrangement was understood to be a temporary parking of inventory rather than a final sale, the recognition of revenue was improper. The earnings process was not complete because the risk of ownership had not genuinely transferred. What this produces structurally is revenue borrowed from future periods. Product pushed into the channel. This quarter is product that cannot be sold into the channel next quarter because the channel is already full. The device accelerates revenue, and acceleration is a debt. Each quarter must ship more than the last simply to stay level, because the prior quarter's stuffing has saturated the very customers who would otherwise buy fresh product. Step 2. The bill and hold arrangements. Where product could not be physically pushed even into an oversaturated channel, the company recognized revenue on a bill and hold basis without meeting the SEC's conditions. Revenue was booked on goods that had not shipped for arrangements the buyers had not genuinely requested for their own business purposes on schedules that did not reflect real delivery commitments. This is the device that severs recognition from shipment entirely, and it was used to fill the gap that channel stuffing alone could not close. Step 3. And this is where the fraud escalated from aggressive recognition into fabrication. The shipment of goods that did not exist as product. The record describes product returned by customers being repackaged and shipped back out as new. It describes obsolete and defective inventory being carried at full value rather than written down. And it describes the packing of bricks into disk drive cartons. A carton containing a brick weighed to match the specification of a genuine drive could be shipped, logged as a unit of finished product delivered, and booked as a sale. The brick generated a receivable. It generated revenue. It carried a cost of goods sold that corresponded to a real drive, further distorting the cost figures. And critically, when it sat in inventory rather than shipping, it could be counted as a physical unit during the audit's inventory observation. Step 4. The inflation of the inventory records directly. This is the weekend in the locked room. Understand what the physical inventory count is meant to accomplish. The auditors attend the count. They select items, they observe quantities, they record what they see, and they seal those records so that the figures the auditor observed cannot later be changed by the company. The count records are the auditor's independent evidence, held by the auditor precisely so that management cannot revise them. The account established in the subsequent litigation describes MiniScribe personnel gaining access to the sealed packages holding those count records and altering the recorded figures to match the inflated inventory the company intended to report. The auditor's own working papers, the thing designed to be tamper-evident and independent, were reached and changed. Consider the combined effect of these 4 steps as a single system. Channel stuffing and bill and hold generated revenue that was not earned. That revenue flowed to the income statement as sales. The bricks and the repackaged returns generated additional fictitious sales while simultaneously providing physical objects to satisfy a count. And the alteration of the count records inflated the ending inventory figure, which by the arithmetic bridge suppressed cost of goods sold and inflated gross profit a second time, independently of the fake revenue. The company was overstating profit through 2 separate channels at once. Too much revenue coming in the top and too little cost recognized against it. The numbers this produced were substantial. The SEC's enforcement record and the related litigation established that MiniScribe reported profits during a period when the underlying business was, in reality, losing money or performing far below the reported figures. Revenue and earnings were materially overstated across multiple reporting periods. The company's reported financial condition bore progressively less relationship to its actual condition, and the gap was papered over each period by more aggressive versions of the same devices. This is the characteristic trajectory of a revenue recognition fraud that begins with acceleration. The initial device borrows from the future. When the future arrives and the borrowed revenue is missing, the gap is larger, and closing it requires a larger device. The bricks are not the beginning of the story. They are the stage the fraud reaches when the ordinary devices, aggressive but not fabricated, can no longer generate enough. Now, the detection question, which is the analytically important one. How did this survive an external audit, and what would have had to be true for it to be caught earlier? Start with the inventory count, because that is the procedure specifically designed to catch inventory overstatement, and it was specifically defeated. The physical count works on an assumption that the auditor's observations, once recorded and sealed, are secure. The entire evidentiary value of the count rests on the integrity of the working papers between the moment of observation and the moment of reconciliation. The MiniScribe account describes a direct attack on exactly that assumption. When count records can be physically accessed and altered after the auditor has sealed them, the count ceases to be independent evidence and becomes, in effect, another management representation. The procedure did not fail because the auditors did not perform it. It failed because the evidence it produced was corrupted after the fact. And nothing in the standard procedure of the era was designed to detect subsequent tampering with the auditor's own sealed records. Consider the bill and hold and channel stuffing revenue. Detecting improper revenue recognition on shipments requires the auditor to test not merely that a shipment occurred and was invoiced, but that it represented a genuine sale under the applicable conditions. For an ordinary shipment, the physical departure of goods is strong evidence. For bill and hold, the auditor must examine whether the SEC's conditions were met, and those conditions turn on facts about the buyer's intent and business purpose that reside partly outside the company. Verifying a bill and hold arrangement genuinely means confirming with the customer that the customer requested it, has a business reason for it, and has accepted the risk of ownership. Where those confirmations were not obtained, or where the confirmations came back through channels the company controlled, the revenue could pass. Channel stuffing presents a related problem. A shipment to a distributor looks like a sale. Detecting that it is not a genuine sale requires understanding the distributor's return rights, the distributor's actual demand, and any side arrangements. Side arrangements are, by design, not in the formal contract the auditor examines. They are the understandings that make the paper sale a temporary parking of goods. An auditor examining the documents sees a sale. The economic reality lives in the undocumented understanding. There is a broader structural point about analytical review. Certain patterns in this fraud were detectable in the numbers themselves, at least as warning signs. When a company channel stuffs, its accounts receivable and its inventory tend to move in ways that diverge from the underlying business. Days, sales outstanding, can stretch as receivables from stuffed shipments age without collection. Inventory turnover can behave anomalously. Gross margins that hold steady or improve, while an entire industry suffers price pressure, invite the question of how. Analytical procedures are meant to flag exactly these divergences, prompting the auditor to investigate further. What analytical review cannot do on its own is prove fraud. It can only raise questions, and the answers to those questions came from a management that was manufacturing the evidence. When the response to an analytical flag is a company representation, and the company representation is false, and the supporting documents have been fabricated to match, analytical review reaches its limit. It points the auditor toward the right question, but cannot supply an honest answer. There is also the question of the environment in which the audit was conducted. The record and the subsequent litigation describe pressure directed at the reporting function and ultimately at the audit itself. When the people producing the financial statements are organized specifically to defeat the verification procedures, when a team is assembled to alter count records, the fraud has crossed from the passive concealment that ordinary auditing assumes into active, coordinated deception aimed at the auditor's specific methods. Audit procedures of the period were built on a presumption that management might be wrong, biased, or aggressive, and that testing would surface those errors. They were not built on the presumption that management would break into the auditor's sealed materials. That gap between what the procedures assumed and what actually occurred is the detection failure, stated structurally. The verification chain assumed the physical evidence was secure once observed. The fraud attacked precisely the security of that evidence. For detection to have occurred earlier, several things would have had to be true. The count records would have needed protection against post-observation tampering, or the count would have needed to be repeated or verified in a way that made alteration detectable. The bill and hold and channel arrangements would have needed independent confirmation from customers through channels the company could not control, with specific inquiry into return rights and business purpose. And the analytical divergences would have needed to be pursued to a point where the answers came from outside the company rather than from inside it. The common thread is independence of evidence. At each point where the fraud succeeded, it succeeded by converting supposedly independent evidence, the sealed count, the customer confirmation, back into a company representation. Detection required breaking that conversion. Now, the unraveling. Recall the structural debt built into the mechanism. Channel stuffing borrows revenue from the future. Bill and hold recognizes tomorrow's sales today. Fictitious shipments create receivables that will never be collected because there is no customer who owes the money for a genuine product. Each of these devices creates an obligation that comes due. The receivables from stuffed and fictitious sales age. They do not get paid because in economic substance, nothing was sold. Uncollected receivables accumulate on the balance sheet. The inventory that was overstated remains overstated, and the gap between the recorded inventory and the physical inventory grows as more bricks and more repackaged returns and more phantom units pile into the fiction. A fraud built on acceleration must accelerate continuously, and no manufacturer can accelerate shipments into a saturated channel indefinitely. The collapse came as these accumulated distortions became impossible to sustain. The company's actual performance, the real disk drive business under the reported one, could not generate the cash that the reported profits implied. Receivables that should have converted to cash did not. Inventory that was carried at inflated value could not be sold for anything like its recorded worth, because much of it was obsolete, defective, or, in the extreme case, not product at all. When the divergence between reported condition and actual condition reached the point where it could no longer be concealed, the fraud was exposed, and the company's reported figures were revealed to be materially false. The consequences established in the public record were severe and structural. MiniScribe's financial statements were revealed to have been materially misstated across the relevant periods. The company faced securities litigation from investors who had relied on the false statements. The company entered bankruptcy. The SEC's enforcement record addressed the misconduct, and the securities fraud litigation produced substantial judgments against parties found responsible for the misstatements. The specific mechanisms, the channel stuffing, the improper bill and hold recognition, the fictitious shipments, including the bricks, and the alteration of the auditor's inventory count records were documented in the course of the investigations and litigation that followed the collapse. The account of the locked room and the bricks in the cartons entered the record through those proceedings, which is why it is available to describe with the specificity used here. Consider what the collapse reveals about the arithmetic bridge. Once the true inventory value was established, the overstatement had to be reversed. Reversing an inventory overstatement runs the arithmetic bridge backward. Writing inventory down to its true value increases cost of goods sold, and increased cost of goods sold destroys the previously reported profit. The same relationship that let the company manufacture profit by inflating inventory forced the recognition of enormous losses when the inflation was corrected. The reversal is never gradual. The overstatement accumulated quietly across periods, hidden in a balance sheet figure. The correction landed all at once in the period when the truth was recognized, concentrated into a single devastating adjustment. This is the general property of balance sheet frauds that feed the income statement. The lie is distributed across time. The truth arrives on a single day. The fictitious revenue behaved the same way. Revenue recognized on shipments that were not sales, on bill and hold arrangements that did not qualify, and on bricks that were not product, all had to be reversed. Reversing revenue while the associated costs remained produces losses. The company had, in effect, been reporting the benefits of transactions while deferring their true economic cost, and the deferral ended all at once. The receivables that never paid had to be written off. The inventory that was worthless had to be recognized as worthless. The bricks in the cartons had generated revenue and receivables on the way up. On the way down, they generated write-offs and no cash. Let me state the structural findings, which is how a forensic review closes. First, this case establishes, with unusual clarity, the way inventory overstatement propagates through the financial statements. Inventory is not merely a balance sheet item. Through the cost of goods sold calculation, it is bound to the income statement by simple arithmetic, and inflating it inflates profit automatically. Any fraud that can corrupt the inventory figure gets an income statement fraud for free. This is why the physical count is a load-bearing audit procedure, and why an attack on the integrity of the count records is an attack on the entire financial statement rather than on a single line. Second, the case establishes the specific vulnerability of revenue recognition rules that sever recognition from an observable physical event. Ordinary shipment-based revenue is disciplined by the fact that goods either left the building or they did not. Bill and hold, by design, replaces that physical discipline with documentary conditions. The conditions the SEC imposed on bill and hold, buyer request, business purpose, transfer of risk, fixed schedule, no remaining performance obligation, exist because without a physical anchor, recognition depends entirely on the truthfulness of the arrangement's terms. where those terms can be written by the party who benefits from recognition, and where the customer confirmations that would test them can be routed through the seller, the discipline is gone. Third, the case demonstrates the limit of an audit that assumes management error rather than coordinated management deception. The procedures of the period assumed that independently observed and sealed evidence would remain independent. When a fraud is organized specifically to reach and alter that evidence, the procedure produces corrupted output while appearing to have been performed correctly. The failure is not in the execution of the procedure, but in the assumption underlying it, that the evidence, once secured, was secure. The regulatory and standard-setting response addressed these structural points. The conditions governing bill and hold revenue recognition received continued and heightened scrutiny in enforcement practice, reinforcing that revenue recognized without genuine transfer of ownership and a genuine buyer request is not revenue at all. Attention to auditor independence and to the integrity of audit evidence, including the security of working papers and count records against management interference, formed part of the broader tightening of audit practice and, later, of the statutory framework governing the relationship between auditors and the companies they examine. The specific pattern MiniScribe exhibited, channel stuffing to accelerate revenue, improper bill and hold, fictitious shipments, and manipulation of inventory records, became a recognized template in the study of financial statement fraud, precisely because it demonstrated how a company could attack every layer of the verification chain at once. The finding, stated plainly, is this: MiniScribe did not fail because of a single false entry. It failed because it built an integrated system in which fictitious revenue and inflated inventory reinforced each other, in which one physical object, a brick in a carton, served simultaneously as a fake sale and a counted unit, and in which the audit procedure designed to catch the inventory fraud was defeated by altering the auditor's own sealed records. The bricks are remembered. But the bricks were only the point at which the arithmetic bridge between the balance sheet and the income statement, ordinarily a tool of honest accounting, was made to carry a load it was never built to bear. When the bridge finally gave way, it did so the way such bridges always do. Not gradually, but all at once, in a single reporting period, when the distributed lie of many quarters was resolved into the concentrated truth of one.